Well, I'm now being joined by the Managing Director of Kotak Mahindra AMC, Mr. Nilesh Shah, to understand what the RBI's decision today means, what it's going to mean for you as a consumer, what it's going to mean for the economy at large. Thank you very much, Mr. Shah. A pleasure as always to have you on the show. Another 50 basis points rate hike. This was something as expected, but are you seeing that desired impact of aggressive rate hikes on inflation, given that this inflation is more supply-led than demand-driven?
So essentially, this rate hike by RBI is as per the market expectation. Albeit there was a portion of market which was expecting 35 basis point rate hike now. But there is a fair amount of consensus on the terminal repo rate in this cycle, which about 3-4 weeks back ago was between 6 to 6.25. Now it is somewhere around 5.75 to 6. So when you know the end point, intermittent raise does not really matter much. Now, will this have an impact on inflation? Answer is undoubtedly yes. As Milton Friedman mentioned, every inflation is monetary phenomena. And when you raise cost of borrowing money, it will have impact on demand, which will have an impact on inflation eventually.
Do you then think that RBI is trying to play catch-up with inflation with regard to the aggressive rate hikes that we are seeing at this point in time? Because even then, RBI has its own limitations. For example, no control, of course, over the supply chain management, for example.
So I don't agree that I say RBI is playing a catch-up game. In fact, RBI has kept Indian economy flying high, with about 7.2% GDP growth in FY23, which will be the highest among major economies in the world. Contrast that to our colonizers' yesterday's announcement, where Bank of England said that despite rate hikes, inflation will rise to 13%. And by fourth quarter, UK economy will be in recession. Many central banks are ensuring that their economy does hard lending, that is, they go into recession in order to control inflation. RBI is keeping economy in fine state and controlling inflation. So I will give full credit to RBI on ensuring that Indian economy flies high with moderate inflation, whereas the rest of the world has to engineer recession to control inflation.
All right, fair enough. You spoke of countries that may face in recession, and our government says there is 0% chance of a recession in India. While you and I both agree our economy may be resilient, how long can we actually remain shielded from the impact and escape unscathed?
So it all depends upon how we capture opportunities. Now, undoubtedly, we have some weak spots. For example, recently, JP Morgan talked about oil prices going to $380 per barrel. In that kind of scenario, there is no way Indian economy will escape the consequences. But other things being equal on oil, today, even in a slowing global economy, India can make tactical moves to benefit. For example, entire Europe today is suffering high energy cost. German, Italian, French companies are also large exporters. Can we ensure that Indian companies fill the gap against European companies manufacturing as they have become uncompetitive with higher energy prices? If we take such advantages of opportunities available, then undoubtedly in a slowing global growth, India can still be a fastest growing economy.
Right. Now, taking forward the point about weak spots for the Indian economy, for a moment, Mr. Shah, let's keep aside the global issues, the commodities prices, the supply chain, etc. What about food inflation? Because that's been quite sticky, and now we're possibly looking at a situation where rice production could also be impacted.
So I don't think so. We are facing food inflation issue. Our granaries have reasonable amount of food grain. And undoubtedly, as you mentioned, rice production in India this year will get impacted. But that's more likely to impact exports of rice rather than domestic availability. In Northeast and Northwest India, monsoon has been deficient, but they are by and large river-fed, irrigation-fed areas. And there will be shortfall in rice production. However, that will have to be met through export shortfall and ensuring that domestic availability of rice does not get impacted. This year, Kharif crop area is less than last year, but it won't have material impact on food grain production other than rice. If August, September rains are good, then probably there is possibility of a catch-up over there also. The reservoir levels are now above its 10-year average, which bodes well for Rabi crop. So I don't think so we have to worry about food inflation. Undoubtedly, the rice importing nations will have to worry about food inflation as the world's largest exporter of rice, India, steps out of the market.
Right. Now, RBI governor also mentioned that sustained inflation will have a destabilizing impact on the economy, something that, of course, we know, but nonetheless, it is a quite grim comment coming in from the governor. So, assuming no major geopolitical event, at what point of sustained high inflation do you believe that the impact will start to show on the economy?
So, I believe if RBI had not raised interest rates by 140 basis points in last few quarters, our growth would have been higher. The RBI's projection of 7.2% GDP growth for FY23 does take into account some slowdown, some shaving of growth as interest rates have been raised. From an inflation point of view, if oil remains in double digit, we will see inflation coming down from here onwards. And by Jan to March 23, inflation should be below the RBI's upper end of target range of 6%. Undoubtedly, for FY23, the whole year inflation will be above RBI's target range of 6%. But calendar year 2023 should see inflation remaining within RBI's target range.
And I have to ask, if the China-Taiwan issue escalates, how bad could the consequences be? In fact, are we prepared to handle yet another shock?
So Taiwan is the largest supplier of semiconductor chips. And any shortage there, we will see on a much bigger scale, let's say 70 mm. The movie what we saw in automobile sector when chip shortages hurt the production and the order book extended beyond 6 months and 12 months and 18 months. What we saw in automobile sector was a trailer. Any embargo on Taiwanese exports of semiconductor chips will create a 70 mm movie of that scenario. We have to hope and pray that China, Taiwan and America behaves responsibly and global supply chain is not disrupted. Clearly, neither the global economy nor Indian economy has ability to bear a supply chain disruption in semiconductor chips, as bearing few countries like Korea and US and Germany. There is no other country which makes semiconductor chips.
Right, fair enough. Going back to the debate about whether or not RBI should be hiking rates so aggressively, and if there should be more tax cuts from the government instead, that has been quite a topic of debate. It's quite a conundrum, isn't it? Because tax cuts by the government on fuel, for example, will reduce the government revenues, increase fiscal deficit, in turn adding to inflationary pressure.
Undoubtedly, government has fiscal deficit target to achieve. And monetary policy and fiscal policy should work in tandem rather than in opposite direction. When monetary policy is trying to reduce inflation, then fiscal policy cannot be expansionary. And I think both Finance Ministry and RBI is playing a good duel. They are moving in tandem, and which is where we are seeing a completely different scenario in Indian economy, where growth is remaining high and inflation is moderating, whereas some of our marquee peers have to engineer recession to bring down inflation. Their monetary and fiscal policy moved without sync with each other, and they are paying the price.
Right. Mr. Shah, nearly $27 billion of foreign outflows this year is what the governor has commented today. Yes, domestic flows have been strong, but do you see FIs returning with the same vigor that they pulled out? And the other part of the question, if the Fed rate hikes continue, we will then have to be prepared for outflows all over again.
So FPI sold India because we were expensive vis-a-vis rest of the peers. We normally trade at about 40% premium to other emerging market peers. Currently, we are trading at 74% premium when I last saw the number. Number two, foreigners made tons of money in India. In countries like South Africa, Brazil, for over a decade, they haven't made any money. For almost a decade, India has delivered double the return of emerging market peers, including China. And most importantly, we were giving exit. Our double return is after foreigners took $35 billion exit. If they tried selling $35 billion in Brazil or China or South Africa, their returns would have become even more red. So we were expensive, we gave easy exit, and we made enough money for foreigners. That's why FPI sold. But after selling India, whatever they have done has not really worked for them. Last month, India was up 9%, China was down 10%. They are 38% of MSCI, we are 12%. So on a 50% portfolio, when you go wrong by 20%, you end up losing job. Clearly, foreigners are in dilemma. Should they continue to book profit in the most promising story in the globe, India? And should they continue to average their losses in one of the worst performing markets, that is China, Brazil, South Africa? We believe at some point of time, inherent growth story of India will attract foreigners. And as we speak, between 15 July to 4th August, they have already brought 12,000 crore worth of Indian equity.
Mr. Shah, recovery from the pandemic is still fragile. Demand was just coming back, and now, of course, the war hit, and now with this extent of rate hike, what then happens to demand and consumer confidence?
Our feeling is that demand is reasonably in good shape. In the Jan to March 22 quarter, FMCG sales degrew by more than 4%. However, in the month of April to June 22, the degrowth is restricted to just about 0.7%. And I'm talking about volume degrowth, not value degrowth, because that will be misleading. As inflation of raw material went up, companies increased the prices. So value decline was not that severe, but volume decline was quite severe at minus 4% plus in first quarter of calendar year 22. That has fortunately reduced to minus 0.7% in second quarter. Let's hope and pray with good monsoon, stabilizing growth, higher employment, we should be in a position to have positive volume growth in FMCG that will ensure that demand continues to remain supported.
Mr. Shah, I can't let you go without asking you about your advice for investors right now. I mean, if we compare to 2008, and how investors reacted at that point in time, there's been quite a bit of maturity. Indian investors really coming of age now. SIP flows are still quite strong, even though the volatile times that we've seen. But given the extent of volatility that we've been seeing, what would your advice be right now?
Follow the dharma of asset allocation. We are in a volatile market. While we are doing well compared to others, undoubtedly we have our weak spots in the form of higher oil intensity and higher trade deficit being run currently. So please maintain equal allocation to equity in today's environment. Be marginally overweight large cap and be marginally underweight small and mid cap. And if at all correction continues to come in equity market, use that as an opportunity to build your portfolio. Don't chase returns. Try to invest during correction.
And finally, a word on the rupee. It's been seeing quite turbulent times at this point in time. Do you expect this level of volatility to continue? And how much more are we likely to see the rupee depreciate?
The destiny of rupee is to depreciate because of our higher inflation and our productivity differential. In our opinion, rupee should depreciate between 2 to 3% every year. Fortunately, with recent bout of depreciation, rupee is nearing its fair value. From here onwards, we are looking at 2 to 3% depreciation every year. Obviously, this is subject to we managing our trade deficit. Last month's trade deficit at $31 billion was very, very high. So we have to control our trade deficit and balance our balance of payment. If that happens, then 2 to 3% depreciation in rupee is likely to occur.
All right, Mr. Shah, on that note, thank you so much for joining us. An absolute pleasure to have you on the show. On that note, we'll slip into a very quick break and be back. Stay on.